Okay, so Revenue and Customs, or HMRC as we like to call for short, have recently published their latest income tax statistics and distributions report, which is a report that will probably send you to sleep, but something us as financial advisors like to have a look through. This report is interesting because essentially it is saying that savers are not doing enough to avoid paying tax on their savings. So in the report, it shows that for the last tax year, so the 23-24 tax year, the amount of income tax collected from UK savers was around £6.6 billion, which is double the amount it was from the previous tax year. And what's more, HMRC have said that they predict that the income tax raised from savings interest for the current tax year, so 24-25 tax year, will be around £10.4 billion. So just to be clear, this is income tax that you might be paying on the interest you earn from your cash savings. Is this you? Are you paying tax on your interest? Because you don't need to be, and you shouldn't be. There are plenty of legitimate ways to avoid paying income tax on your savings interest. And in this video, we're going to run through what those ways are. My name's Carl. Welcome to the channel. In these videos, I'm just trying to get across, not advice, but guidance and ways that you can build wealth and protect it and avoid paying large amounts of tax. We cover subjects such as financial planning, retirement planning, pensions, investments, and tax. Okay, before we jump in and look at ways to avoid paying income tax on our savings, let's just look at how tax actually works on savings. So before April 2016, banks used to pay all interest net of basic rate tax. So you would receive the interest on your savings after a deduction automatically for tax. And this was a bit annoying, particularly if you were a zero taxpayer. You weren't due to pay tax on your savings, because it meant you had to reclaim that tax back from the government, and it just meant that you didn't have that interest. The bank was sort of keeping all, the government had it before you got to have it, so it's very frustrating. But since April 2016, banks now pay all interest on savings gross, so there's no deduction for tax. What this means is that you need to be careful and account for it. At the same time that banks started paying interest gross, there was something launched called the personal savings allowance. So what this means is that if you're a basic rate income taxpayer, you're allowed to earn up to £1,000 of savings interest before you pay tax on it. And if you're a higher rate taxpayer, you're allowed to earn £500 worth of saving interest before you pay tax on it. There is no personal savings allowance for additional rate taxpayers. And since the 6th of April 2016, as well as banks paying interest gross, they also report all interest earned to HMRC Direct. So there's no way of hiding the interest that you're receiving from these banks. There is also further relief available for savers if you have a low or no other income. And that's something called the starting rate for savers. So this means that if your income from other sources, so things like salary from your job or other pension income that you're receiving if you're retired, if that is below £17,570, then you could potentially earn up to £5,000 worth of savings interest and not be taxed on it. Now, the starting rate for savers, that £5,000 allowance does reduce by £1 for every £1 of income you have over the personal allowance. And the personal allowance is currently £12,570. So, for example, someone who earns income from a job of, say, £14,000 a year could receive a further £3,570 in saving interest without paying tax on this interest. Plus, they would still have their personal savings allowance available as well. So there are two reasons why HMRC are starting to receive a large increase in income tax from savings interest. HMRC have said income from savings is significantly more in 2024 to 2025, approximately 6 times greater than 21 to 22, largely due to the actual and forecasted changes in bank and building society interest rates following the large reductions in bank and building society interest rates up to the end of 2021. So as we all know, interest rates paid on savings were low for a very long time, and it's only natural that as interest rates have risen, HMRC are going to start collecting more income tax from a higher amount of interest. But there's another factor at play here as well, and that is the frozen personal allowance, the amount of money you can earn before paying any income tax. So from the period 2014 to 2015 to 2021, 2022, the personal allowance increased from £10,500 to £12,570. And this was an average yearly increase of 3.06%. But since 2021-2022 tax year, the personal allowance has remained frozen at £12,570 and is currently scheduled to remain that way until 2026. Had we continued the average increases since 2014-15, the personal allowance should now be in the region of £13,758 and £14,179 by the time we get to 2026. So earnings from work and the state pension generally increase with inflation each year. So this means it's using up more and more of your personal allowance because the personal allowance has remained frozen. And this in turn pushes everything else into the different tax brackets. So the more earnings you receive, if brackets are frozen, it means some of your money could start falling into higher tax brackets. So if you're currently a basic rate income taxpayer, you might start falling into being a higher rate taxpayer. And if you're a higher rate taxpayer, you might fall into the additional rate band. And it's earnings from things like your employment and pensions that are taxed first before your savings interest. So the last thing you want is your savings interest knocking you over into the higher tax banding. That 5% interest rate you earn on your savings doesn't look as good if it's only 2.75% after paying highest rate of tax. But thankfully, there are plenty of ways to avoid paying any income tax on your savings. Now, because interest rates have gone up, and the personal allowance has been frozen along with the income tax bands, it doesn't take holding a lot of cash to start paying income tax on it. So now I'm going to run through 6 ways that you can avoid paying income tax on your savings interest. Okay, the first one is a pretty obvious one, but it's worth mentioning, and that's to check how much cash you actually need to hold. I mean, one of the easiest ways to avoid paying income tax on your savings interest is to not have too much in savings. So whilst currently it may feel good earning 4% or even 5% in a bank savings account, that's still quite a low return compared to investing in other assets over the long term. It may feel safer holding your money with a bank and earning a guaranteed rate of interest, but you're missing out on those future returns from other assets like in shares or property or even gold. And remember, most banks don't hold enough deposits to cover all the savings with them. So are banks really that safe? Now, I know there is the £85,000 deposit protection, but if we had another 2008 global financial crisis scenario, do we really think that the government is going to bail out all the banks again? I'm not so sure. The UK finances are already in a really bad state. So when it comes to holding cash, you only really want to be holding enough to cover any short-term liabilities you've got, big spending that you've got coming up. And then the rest of your cash should be held as a bit of an emergency fund to cover anything from between 6 months or 2 years worth of spending, depending on how cautious you want to be. The rest of your money should either be used to pay down very expensive debt or to be invested for the longer term, earning better rates of return from things like shares, property, or even gold. Okay, the second way to avoid paying tax on your savings interest, and it's another obvious one, but it's worth reminding you, is to make sure you're using your ISA allowances. Now, I'm sure you're all on top of this, but just as a reminder, you're allowed to put in up to £20,000 per tax year into an ISA, and that's on top of previous year's ISAs that you've already built up. All interest earned on cash inside an ISA is tax-free. Just make sure that when you're setting up an ISA, it's a flexible ISA, as this will allow you to withdraw money in the tax year if you need it and put it back in the same tax year without jeopardizing your ISA allowance. It's also worth making sure that the ISA provider allows the additional permitted subscription, which means that should something happen to you and you unfortunately die, your partner is able to inherit effectively your ISA allowance without it all falling outside of an ISA. Okay, the next way to avoid paying tax on your savings interest, if you've maxed out your ISA, the next thing to look at is premium bonds. So premium bonds are administered by the National Savings and Investments, which is the UK government's bank effectively. So all money held with NS&I is 100% backed and protected by the UK government, supposedly. Now you can save up to £50,000 in total. That's not per year, in total, into premium bonds. And with premium bonds, they don't actually earn an interest like normal cash savings. Instead, your premium bonds are entered into monthly prize draws. And you can win anything from £25 up to £1 million every single month. All winnings are tax-free from premium bonds. Now, the current annual prize rate at the time of filming is 4.4%, which means this is roughly the amount of winnings you could expect on your money saved in premium bonds throughout the year. But of course, it'll all depend on how lucky you are. That's sort of as an average. Now, Martin Lewis Money Saving Expert website has a really good calculator which gives you some idea of how much you can potentially win through premium bonds. Now, the next thing to look at after your ISAs and after your premium bonds is to consider your pension. Now, I know you might be thinking, well, pensions are usually used for investing money, and the whole point of cash is we want it more secure and safer. That's absolutely fine. The beauty with pensions is that although the ISA only has a £20,000 annual allowance, pensions potentially have up to £60,000 a year as an allowance, depending on how much you earn. But with pensions, you don't necessarily need to put this money into the stock market. Within pensions, you can put your money into something called money market funds. Now, these funds are very low risk in terms of they offer very short-term debt between banks, companies and governments. So these, you actually receive the rate of return that the banks lend to each other. So currently, if you put your money in a bank and earn a rate of interest with that bank, they're only going to pay you that interest after they've taken a slice off the top. Whereas you go in via a money market fund, you're getting the direct rate that these banks lend to each other at. So it tends to be a little bit higher. It's usually very low risk in terms of the people that are doing the lending. They're usually safer banks or very safe governments. But what this means is any interest earned on savings inside the pension is tax-free. The only downside to putting your money in a pension is that you can't actually access it until you're 55. So this solution may only be appropriate for people who are approaching retirement or already retired. Okay, the next way to avoid paying tax on your savings interest is to use something called government gilts. In particular, gilts with a short maturity. So a gilt is essentially a loan to the UK government because the UK government doesn't earn enough money through taxes to currently pay for all of its spending. So it has to go to the money markets and request loans essentially. So you can lend money to the UK government. They will agree a fixed rate of interest up front and guarantee to repay you your capital at the end of an agreed term. Now, once these gilts are set up and produced, they are then tradable on the secondary market. Now, the gilts we're interested are very short-term gilts that pay a very low rate of interest, because what we're interested in is buying the gilts at a discount to their final maturity. So for example, if I go onto the Hargreaves Lansdown site, and Hargreaves Lansdown are a stockbroker essentially, I can see a list of the gilts that they're offering in the market. And I can see one here that is paying 0 interest, and it will mature effectively at £100 per unit in March 2025. But I can currently buy this gilt for £92.80 per unit. So if you invested £9,280 into this gilt, you would receive back £10,000 in March 2025. That's a 7.2% return before any fees have been deducted. And the best bit is tax-free. There's no capital gains tax on gilts. You just need to be careful on UK gilts that offer a higher rate of interest, because the interest accrued on gilts is subject to income tax. So we're looking for those gilts with very low rates of interest paid, but are at a significant discount to their par value. And once the gilt matures, you can obviously then have a look and buy another one on a short-term basis. Okay, and our final way, our 6th way of making sure that we avoid paying income tax on our cash savings is to ensure that you're using both yours and your partner's allowances as well. So we've previously covered your ISA allowance, your pension allowance, and the premium bond allowance. But if you use your partner's allowances as well, this means a potential £260,000 could be sheltered from having to pay income tax on your savings. And just remember, if the bulk of the wealth or savings are in your name and your partner has very little, if you're a married couple or in a civil partnership, there is no capital gains tax charge between moving assets between each other. So you can make full use of each other's allowances. You could also pay into junior ISAs and even junior pensions for your children as well if you have some. So just remember, the key message from this video is that you do not and should not be paying income tax on your savings. Just going to ultimately reduce the final interest rate that you earn. I hope you found this video useful. If you have found some value from it, please give it a like and add any comments you wish to make. I'll try and read through them all and answer any questions you may have. And please don't forget to subscribe to the channel. Until next time, take care.